Hello, and I welcome you to today's webinar, Admiral Markets Weekly Market Outlook, together with me, Jens Klatt. This is, as you can see, the webcam is on here, so which means that we are trying something new, and it's not only new in our old webinar tool, but today we are using, this is the first webinar official start with a new webinar tool and Zoom. So, and yeah, we are trying things out, and hopefully everything will run as smoothly as usual, as you have seen it, or yeah, as you have seen it in the past with GoToWebinar. As usual, we want to start with the risk disclaimer here, and then take it from there. Trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. Before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral. Therefore, check out the website, admiralmarkets.com. That were only the first 2-3 sentences of the risk disclaimer. The full risk disclaimer can be found on the website. As usual, we want to have a look here at the so-called ESMA decision. It's differentiation now taking place between retail clients and professional clients. And what this means here, since August 2018, is the following. There's now a leverage restriction for retail clients with a max of 1 to 30 in Forex majors like EUR/USD, for example, $JPY, GBP/USD, but also a leverage restriction of 1 to 20 in case of the DAX, for example, DAX 30, in CFDs on indices in general, but also on gold, for example. And now the differentiation between professional and retail clients is as the following. Professional clients, if you meet certain criteria for that, please feel free to reach out to the customer support from Admiral, respectively join the website and look at the criteria you have to meet to be reclassified as a professional client there. There is the differentiation that you as a professional client probably, not probably, you do not have such a leverage restriction, so you can keep on trading with a leverage of up to 1 to 500. There's nevertheless one big difference. So as a retail client, it's not only that you have the leverage restriction, but ESMA decided that you also have no negative balances, or the risk of seeing a negative balance in your account. That's not necessarily the case when you're reclassified as a professional client, even though in case of Admiral Markets, the special offer here, let's call it a special offer, I think that's probably the best way to put it, is that you're safe of up to £50,000 according to the policy from Admiral Markets in case of a negative balance. Also, for further information, feel free to reach out to the customer support from Admiral. So yeah, usually I say this is the face to the voice you're currently listening to. Usually you should see the face already here in the webcam, so this is no big surprise. The probably very interesting part at my end is that I'm located in Berlin, in Germany. You will see the next slide that Admiral has several offices around the globe, and also one in Germany, for example. And here in Germany, and the office is also in Berlin, by the way. So here in Germany, the thing which is of highest interest when talking about Admiral Markets as a broker is the very, very competitive offering when it comes to the DAX in this case. So with a typical spread of 0.2 during the main trading hours. There's also an offering which is of high interest, especially for short-term traders, scalpers especially. There's an offering of a spread of 0.2 in the DAX then with the prime offering, and then you pay on top of that a commission of 60 cents per CFD. So which means, so 1 point equals 1 point equals €1. So that's what I wanted to say. So in addition, you are coming out at 0.8 per CFD in terms of cost. Still, the spread is tighter, which means, especially as a short-term trader, this is probably very interesting. The same in regards to Admiral Prime is true for the FX offering. It's also very, very competitive, and I highly recommend check out the website. And this is something I already mentioned, one world global offers. So it's not only the case that Admiral Markets, for example, is FCA regulated in the UK and authorized by the FCA, but also, for example, by the CISIC for the European Union. And here the question surely is, okay, how will things go regarding the Brexit? But also, for example, Admiral Markets holds an Australian financial services license, AFSL, to carry on financial services and business in Australia. So all this, what this means, feel free to reach out to the website, contact the customer support in your respective language, and yeah, check out Admiral Markets. I can only recommend it. And there are the contact details. I mentioned this several times now. And now let's switch over here to the agenda we want to look at today and which questions we want to answer. So the main questions which will be answered today will be what are the key economic events in the coming week of trading? So different to the week before when we also talked about the non-farm payrolls especially, and we want to look at this because it affected the price action of the last days, especially after the comments made from Jay Powell, the Fed chairman, in front of the US Congress here on Wednesday especially. We want to definitely look at the non-farm payrolls. Next week, economic calendar is not very packed. It's compared to the week before, especially, it's quite thin. Still of interest, especially when it comes to the developments in yields, especially US yields here in this context. We also want to answer, surely the answer, or give an answer to the question, what's the current bias in FX, equity, and commodity markets, especially after the comments from Powell, and then also which trading opportunities may arise from that. And so let's, perfect, that's great. So I focus that strongly on the new software on Zoom that I completely forgot to open my Admiral platform. And you might be surprised now to hear that. How can a trader not use the platform? So usually I'm working with a VPS, so a virtual private server. And so I run this on a different computer if you want. And now it probably takes several seconds and then the platform will be open. Still, we can already start and talk about the interesting developments then in the DAX. So there has been an attack at the region around 12,300 points today. Some of you might have seen it already. And we haven't yet broken through this level on the downside. And I think this is very interesting because around 1 week ago, yeah, it's in fact nearly 1 week ago, on Monday this week, so 5 days ago, we talked about in a technical piece which was published on the website from Admiral Markets, and therefore let's switch over here to the website here. So this is the website, and there you can find it via analytics and their technical analysis. And for whatever reason, the MT5 is not opening, but it will. And here, there we go. So let's first of all look at the technical analysis section. Scroll down a little, and there have a look here at the bearish divergence in the DAX 30 CFD. The question here was in the header, test of 12,450 ahead. And that's definitely something. This is really interesting because for whatever reason, yeah, there we go. There we have it. Finally, we made it. We've seen this divergence forming. Let me first show you here this chart from Monday. So what we've seen here is that the market made higher highs and then didn't confirm them here in the RSI 14. It's a very simple approach. In fact, it's only an indication, but an indication which points probably to the market losing some steam, losing some momentum on the upside. And so with this in mind, the thing is that here, it didn't come as a big surprise to see a corrective move, minimum as low as 12,450 points, a region where a gap has shown after the G20 summit in Osaka. That was the week before from Monday. And the market stabilized at an elevated level, drifted a little higher, but still there was no really momentum taken on. And in fact, we corrected yet now on the hourly chart. Hello, there we go. So as you can see here, okay, let me just help my PC a little. 1 second. Let me just close some windows here in the back end. So usually that shouldn't be an issue, but as you can see here, it obviously is. So there's the corrective move in the hourly chart. So that's the chart we've just looked at here. And there we ended it, and then from there we went lower, and we closed this gap. And not only that, but dropped also lower here. So over the last days, we've seen some choppy action. So there was series and several attempts to make it back to the yearly highs, but we failed each time. And this comes as a surprise, especially from a fundamental perspective. The reason for that is that the comments from Jay Powell here in front of the US Congress pointed to a quite dovish approach, which should be expected from the Fed then in the months to come, and which brought back speculations around not only a 25 basis point rate cut at the next meeting here in July. We remember that was a topic over the last days and was also a topic last week around the non-farm payrolls here. So there was the Fed Watch tool. And as you can see here, the current target rate is at 225 to 250 basis points. And as you can see here, the expectation is 100% that there will be a cut. The only question is, in fact, is the cut 25 basis points or will it be 50 basis points? And last week, with the non-farm payrolls coming in significantly better than expected, even though we are only talking about the number itself, it's not in regards to the average hourly earnings, for example, or the unemployment rate, but it was only the non-farm payrolls and the number which was published at over 200,000, and surprised on the upside. You probably remember the distribution I showed to you from Bloomberg with those columns here, where I said that based on the ADP data set and also based on this, markets expect the non-farm payrolls to come out somewhere between 160 to 180,000. And they came out at 224,000, if I'm not mistaken. So it was nevertheless 220,000 minimum. And so that resulted in the fact that here, this column on the left, so 225 to 250, that means a cut of 50 basis points or 0.5% brings us down to 175 to 200 here. And this is very interesting because this column was completely priced out. It was completely erased. And as you have probably seen, the push in the US dollar higher last week on Friday, or respectively the corrective move in gold below 1,400 USD, resulted out of the fact that market participants saw only, in fact, a cut of 25 basis points, and probably only that for the upcoming 6 months, speculating that potentially the next numbers coming out from the US economy will support such a, let's call it, more restrictive view, probably. And this is of high interest, in fact, because you can see now the column came back. So where did it come from? And this resulted out of the fact that Jay Powell sat in front of the US Congress the following. He was saying that a number of government policy issues have yet to be resolved, including trade developments, federal debt ceiling, and the Brexit, and that there is a risk that weak inflation will be even more persistent than the Fed currently anticipates. So this is something I prepared here already via Twitter, that you can see it. That was the punchline. The result was that the US dollar was under serious pressure, and we'll see this in a chart in a few seconds, that euro gained tremendously against the US dollar. Also, equities pushed higher. And usually you will say, okay, this is something which is equity friendly, at least. And you expect equities to gain from that. And in fact, the S&P, for example, the S&P gained, let me just see here, the S&P gained, and for the first time saw the index rising above 3,000 points. And as you can see here, we stabilize at this level. So the reason is quite simple. It means more liquidity. The funny thing, let's put it that way, here in this regard, is that if you're somehow concerned, let's say, about the federal debt ceiling, and you bring in more liquidity, keeping rates lower for an extended period of time, or suggesting that cutting rates is necessary to stabilize the US economy, that somehow difficult to bring in one sentence. So I'm concerned of the federal debt ceiling. That means I need a more restrictive monetary policy path I have to follow, or I'm not concerned of it and I can cut rates. But it's not, at least not in my world, let's say, it's not possible to have both. And still, the thing is that lower rates usually go hand in hand with equities pushing higher. That's something, again, you can see here in the S&P, first time 3,000, that's a psychological level, which is relevant, but also here from a statistical standpoint. Let me just show this here, probably in a higher chart. I'm sorry, in a bigger chart. So as you can see, it's a statistic. It's brought up from Ryan Datrick. If you're on Twitter, I highly recommend following this guy because some of his statistics are just phenomenal. It's just great. And as you can see here, the question he answers with this chart in a few seconds, we have the big version of that. The question is, can the Fed really cut rates with stocks at new highs? This question was already answered. What's more higher interest in this context is if you go back to 1980, this happened in fact 17 times, with the S&P trading 2% of new highs. Currently, the S&P is trading at new all-time highs. And the year later, the question was, okay, is it higher or lower from here? And as you can see, the S&P was higher all 17 times. So this approach from pure statistical standpoint seems to have a positive expected value if you trade equities long from this current moment on. And so the concrete details can be found in this chart then. So first time it was in 1980 itself, the S&P was trading 5.5% higher here. And you can see each time, the last time this happened is over 20 years ago. That was on the 31st of January, 1996 in this case. We all know that there were several times, for example, in case of 1986 here, that around 1 year later, there was a tremendous crash. There was this Black Monday. Probably some recall it, probably some you have just heard about it. As for example, I was only 3 years old at this time. But in fact, there have been times where this wave of cheap liquidity resulted in the complete opposite. And you didn't necessarily see always the market pushing higher, and never looking back. Still, it's at least short term for the next 12 months a good idea to be bullish for equities instead of being bearish. And so with this in mind, the thing is very interesting to see, or to look here at the DAX and what happened there. So initially there was this bullish reaction. So this is here, this candle from Wednesday was a bullish one, but we failed to make it back towards 12,500 points. In fact, shortly after we pushed lower, we've seen then, thanks to some positive signs from the US market, from Wall Street itself, but also from the Asian markets overnight, we've seen the market trading higher, the DAX being pushed a little higher. Still, we were sold off yesterday in the morning again, stabilized then again, only shortly to push lower then, drift higher again, and now we push lower again. So the interesting thing about this is, and why do I mention it, is that usually you expect equities to react positive in that way, and especially the DAX react in a positive way, similar to the S&P. That this does not happen is a sign of relative weakness, in my opinion. Still, I think that there are serious signs to be careful with short engagements. Even though it's relatively weak what the DAX delivers here, we can also see, and now we have the opposite being shown, the second, or the opposite side of the medal here. It's not only bearish divergences, but it's also bullish divergences. In this case, we make lower lows, and we have a structure which is trending lower. Still, as you can see here in this context, we are trending lower. Yes, still, this is not a real dynamic move, but the market is it's trending lower in a choppy way, let's call it. And so with this in mind, I think chances increase that, especially if we can stabilize against 12,300 points on the downside, that here in the days to come, there will be a push higher. I think, and this became obvious already, we are very, very dependent on the US equity markets here. But if we can here stabilize against 12,300 and the DAX can probably make it back above 12,400 points, the next significant region can be found around 12,430, 470. And if we make it above that level, wherever this positive impulse comes from. If we make it above that level, further gains up to the yearly highs become definitely an option. And so let's have now a look here at the daily chart. You probably may be surprised that I'm positive for the DAX, but let's look at it here from a higher perspective, and you will see that we are clearly in a bullish mode. We have now the first week. In six weeks, we have closed 5 times higher now, and this is the first week that we are seeing losses, and probably we are also somehow, this is kind of a, let's call it cognitive bias probably, because we've lost every day now. So from Monday, it was red 4 signs or negative 4 signs, and this continued till yesterday, and it is of high, there's a high chance that we'll continue to see a red 4 sign today here too. Depends on what the US markets deliver, but still, and this is usually a sign of weakness, and this is something to be a little scared about, let's say. Still, the overall mode stays positive, especially as long as we trade above this blue line. This is the SMA 200, simple moving average 200, and it also is positive, in my opinion, as long as we trade above 12,150 points from a short-term perspective. So with this corrective move now showing first signs of diminishing bearish momentum, from a risk-reward perspective, long engagements really seem to be attractive in the DAX here. And I really could imagine the market to push higher. Again, we highly depend on US equity markets. And if they fail to take on further bullish momentum, and this is let's call it a fake out on the upside here above 3,000 points in the S&P, sure, then we have a chance also here to gain further momentum on the downside and probably outperform from a bearish perspective when looking at the relative weakness that the DAX has shown so far. But I think there's a high probability of the DAX stabilizing here and probably pushing higher, especially if we make it back above, let's use a round number, 12,450 points. Yeah, so that's it on the DAX. Sure, we also want to have a look here at the euro. In fact, the picture is not very promising, let's say. It's didn't really change from last week. Last week we closed here. Let me just zoom into the chart a little. So you can see here this candle that was last Friday. That was on the 5th of July, 1 week ago, and you can see that we pushed towards, and then also here on Monday and also on Tuesday, we slightly dropped below 112, but this was reversed nearly completely then, with the comments from Powell pointing to, or bringing back, let's say, a 50 basis point rate cut on the table. What I think is really interesting in this regard right now is we haven't really seen significant strength. And there's also another sign which I'm irritated about, let's say, respectively, which is very surprising. And therefore, I prepared a chart. Let me just close this one and close this one and keep this one open here. So what is this? This is the Commitment of Traders report on the T-note future. So it's 10-year yields, US yields. And why is that of interest? It's of interest because the green line is in negative territory here. So it probably is nothing, you don't care about it, but I think it's impressive because this is the large speculators. And what we know in case of the T-note future, or in case of bonds in general, is that there is a negative correlation to yields, which means if you are long bonds, you are betting on lower rates, while if you are short bonds, then you're betting on higher rates. When looking here at the 10-year T-note future and the fact that large speculators, and here we're talking about big financial trading advisors or commodity trading advisors, hedge funds, asset managers, all these guys are usually pro-cyclical position. So that means they are going with the overall trend. If the trend is long, they are usually long, and if they are short, they're usually short. Problem is they're most of the time wrong at turning points, which means that if the trend goes from long to short, for example, they're based on their volume, they have difficulties to switch in a quick way. So they just can't exit the position as we as retail traders can, just clicking the button and we are out. And it does not really affect markets, but due to the billions of dollars and euros and JPY they're managing, usually you have difficulties to exit the market then. So now, when you're pro-cyclical positioned with the trend, and you see large speculators being net short T-note future, that means they're betting on higher rates. And we're now looking not only at the comments from Jay Powell here, but also looking at, for example, the Fed Watch tool, and here going up to December 2019. So this is now the outlook for what does the market participants expect in terms of yields, in terms of the Fed and the monetary policy path they follow within the next 6 months. When looking here at this, you can see that with the likelihood of over 80%, they expect 3 rate cuts. Why do we say that? The current rate here is 225 to 250. So you can see they expect minimum 1 cut by 100%, because there's no column here showing that one market participant is expecting the Fed holding rates. And then, as you already have seen, they expect 1 cut already at the July meeting in around 2 weeks. So next Wednesday, 2 weeks then. So if you sum up this first column, 1 cut, a second cut, and here a third cut. So each of 25 basis points, you sum up 36.1, 36.8, and 11.4%, and you get way over 80% of 3 rate cuts. Oh no, I'm sorry, that's wrong. no, not getting 80% of that. No, you have to go the other way around. I'm sorry, that doesn't make sense. It's 80%. Of 100 expecting 1 rate cut. You have to add this way around, not the other way around. If you add up those columns here, these market participants, in addition, they add up to slightly above 50%. And these 3 columns mean that markets are expecting, with a majority, that the Fed will cut rates 3 times. So this in mind, market participants here betting in the majority that the Fed will cut 3 times, and looking at this chart does not add up. So someone is wrong here. It's the market is betting on rate cuts, and let's face it. I mean, here this picture perfectly illustrates the wording, the rhetoric used by Jay Powell. It also perfectly illustrates the last economic data. I mean, non-farm payrolls last week, they came up better than expected, yes, but then on the other hand, we have to say it's only one data set, and it doesn't overly change the picture for the overall US economy. When looking at, for example, the yield curve, you can still see an inversion there, which is a sign to a potential recession forming on the horizon. So there are several signs pointing to a recession. Let's remember IDP data, for example, from last week on Wednesday, with the small businesses showing the second significant drop in a row on a month-to-month basis, which is a clear sign that small businesses are exiting the market due to obvious problems they face in regards to their business. And usually they can, or they should be interpreted as kind of a leading indicator for the US economy. The same, by the way, the same argumentation applies here than the big speculators and the retail traders I was just referring to. This is the same as big companies and small businesses. So a big company can not exit the market as quick as a small business can. Let's say I, as a one-man company, for example, I can just say I'm done. So I end my business here, and I'm not having any employees, any responsibility or something. I just can exit the market. This is not true for a big company like Boeing, for example. So or Microsoft or something. They can just adapt to the market conditions and or to the economic outlook. And so with this in mind, this here seems to paint a better and more accurate picture of the reality than what we get to see here. And why is that of interest? I think rather sooner than later, these market participants have to adapt. And what does this mean? That means they have to buy back T-note futures. buying T-note futures in the current market environment means nothing more, especially if this is probably here induced by kind of a risk-off move or something, that we are we have a greater chance to see something like a squeeze, a massive squeeze in this case on the upside, respectively a sharper drop in yields, which is then also very interesting from a trading perspective. Why is that? Well, have a look here when it comes at the Euro USD. So seeing such a squeeze and seeing especially the yield sensitivity in regards to the US dollar, but also to equities, there's a good chance that we could be about to see, if such a squeeze is about to happen here on the upside in T-note futures, we could see a sharp push higher in the Euro USD, for example. In this case, not only back above 113, but probably going for an attack of 114, 114.50. But also, for example, this could act as kind of a trigger for this bullish move here. I just made a topic in the DAX, and why I'm not very optimistic for the bears here. Even if we, by the way, and don't get me wrong, even if we make it now below 12,300 points and see some short-term dynamic on the downside, doesn't necessarily mean that the picture I painted with the bearish divergence is not coming true, respectively playing out as I described it. It's probably only that the market is dipping a little lower, but as long as we hold above 12,180, 12,200, probably some optimists will say everything above 12,150 is still attractive from a risk-reward perspective, in my opinion, and plays the overall long-term environment in which we find ourselves on when looking at the daily chart. Still, when coming to currencies here, I'm not really confident that that here trading the euro long is a very good choice. The reason I made it already clear last week, this picture hasn't changed. So with the potential appointment, or being the potential successor of ECB President Draghi here, Christine Lagarde, the current chairwoman and managing director of the IMF, I'm a little skeptical if the overall outlook for the euro is very positive. So I mean, she's definitely a good choice when it comes to saving the euro, let's say, or forthwriting the story which was written down from Mario Draghi during his presidency. Still, the approach, whatever it takes, will most likely result or mean nothing more than more stimulus from the ECB, which is more likely to drive the euro lower. And with this outlook, betting on US dollar weakness, I'm not sure whether the euro is a good counterpart here. Probably when you're skeptical about the US dollar, or when you about to see such a squeeze in US yields, which is most likely affect the attractiveness of the US dollar in a negative way, you probably say, okay, then long engagements in gold, respectively short engagements in US dollar JPY is probably a better choice. Therefore, also here, this picture is quite interesting. In dollar JPY, for example, so after the non-farm payrolls last week came out, it looked, at least for a short period of time, as if we can really make it back above 109. So I want to be honest, I was surprised by this strong data set last week. So you can easily watch the recording of the weekly market outlook on YouTube, on the YouTube channel from Admiral. You can definitely see that I was very, very optimistic for a bad data set, so pessimistic about the NFPs here. And if they came out better than expected, I had to rewrite my picture in my mind, even though it was easy because it was the complete opposite of what I just described. So I just had to give it a -4 sign. If it was bearish for the US dollar, that was bullish, and the other way around. So being bearish for dollar JPY last week meant driven by the good NFP data set, becoming bullish for dollar JPY, or at least seeing another attempt to make it back above 109. And that was also something which took place, or where we saw an attempt over the last days, or Monday and Tuesday. And then on Wednesday, with these comments from Powell and bringing back the speculations about a 50 basis point rate cut for July, it resulted in a quite sharp drop here in dollar JPY, and it continued then yesterday, which brought us as low as 107.80 around, and back below 108 into the evening. Yeah, in my case, evening. So afternoon, evening, European time. The US dollar gained some momentum. Main driver for that was the inflation data, which was published. Just take out these charts here, the inflation data, which was published then, and here we have a look at the core inflation rate. So in fact, inflation data itself pointed to a lower reading in relation to the month before, so 1.6%. But here I look at the core inflation, so taking out volatile items as oil, for example. And so here you can see that the consensus was not only just met, but we came in at 2.1% instead of 2%, which somehow took back the speculations around the rates cut by 50 basis points. So this is in fact what it's all about. It's 50 basis points, yes or no. And this is what's driving right now the equity markets, respectively, not only those equity markets, but also US dollar and FX markets. And so with this reading here, this speculation dropped a little. It was only a small push. So yesterday in the morning, we had a speculation or a percentage of 30% here for such a 50 basis point cut. And then you've seen it a few seconds ago, it was around 20% today, or respectively yesterday already, after this reading came in here at 2.1%. Still, I don't think that this is a game changer here, which means nothing more than that dollar JPY has a serious chance to take on another push on the downside. And especially if we push below 107.50 here, I think there's further losses very likely, which will drive us as low as 106.80, respectively. Also, if a push lower occurs, then the next target will be here around 105. These are the flash crash lows from January, yes. Also something to keep in mind, especially when remembering these ideas, these thoughts in regards to yields, we have a positive correlation. Let me just give you one chart. That's a chart. It's a German chart, and I've shown it in my first book. The first book was Forex Trading. It's a German book, so it's not really interesting for most of the attendees here. But I think what's very interesting about this is I pointed out in this chart already. That's a chart from 2014. I pointed out the correlation between 10-year US yields and the dollar JPY. And this is very interesting because, as you can see here, so it's a 10-year UST note yields. It's in orange, and then you have in gray here dollar JPY. You can clearly spot a positive divergence. We won't dig too deep into details here why this is the case, even though it's very easy to understand. It's the yield sensitivity of the JPY due to being a low yield currency or zero yield currency, and once there's a risk on mode in markets, and markets are looking for yield. They're usually going for the high yield, especially when it comes to the same rating. In this case, it's JPY or Japan is a G7 economy, and we have also the US as a G7 economy. If the US has a AAA rating and Japan has a AAA rating, well, that means nothing more than you usually take the currency with a higher yield. And in this case, zero yield currency is unattractive, JPY, while the higher yield currency, US dollar, gets attractive, or is more attractive, and you should probably use this as a portfolio component, let's say. So so with these thoughts in regards to yields, US yields potentially pushing lower, especially if such a squeeze happens, that means nothing more that this could trigger a bearish move in dollar JPY in this case. So meaning nothing more that especially dollar JPY is still sensitive, and any push lower in yields and any weakness in the US dollar is most likely benefiting or letting benefit the JPY in a very, very positive way. Only problem with that is if you hold this trade for quite a long while, and this is a, let's say, midterm investment or trade, the only problem you have to focus or you will face here is that you have to pay for holding such a position. So the timing is very, very important in regards to dollar JPY engagements in this case. And you're not only betting on yields drifting lower, US yields trading lower, but you're also hoping for some kind of risk aversion hitting the markets and quickly letting your position gain in this regards. But from a purely research perspective, short engagements in dollar JPY in such an environment which I just described should be definitely favored. On the other hand, also interesting, surely gold. So what we've seen here was last week on Friday with the NFPs being published, what you've seen is this sharper drop lower here. That was the candle from the 5th of July. We push as low as nearly 1,380. And then we stabilize against this level. And here on Wednesday, the push higher, quite aggressive, back above 1,400. Powell. That was the only reason. Yields pushed lower. This is a positive driver for gold in this regard, and yeah, pushing the precious metal higher in this case. And so we keep on stabilizing between 1,380 and 1,440 USD, as long as there's no big fundamental news being published in the days to come, and this is very likely. The only thing which is of interest for market participants in the next week, which is interesting for us, is, let me just go back here to the Forex calendar. And let me just see if it's still the filter I overlaid it with. Probably it is, or not, or yes, or no. Okay, 1 second. So this is only today. So we want to look at it here till next week. And now you can see here, we have to check all these currencies we want to look at. In this case, it's G8. No, it's G9 in this case. I think New Zealand is not in it, however. So you can see it here. The only data set which is of interest here potentially for gold traders is retail sales next week. And I doubt to some extent that this is really a market mover. Still, be careful in regards to yields and carefully watch developments in yields and the T-note future. This is definitely of interest when it comes to gold, since any move here and any significant push lower in yields is most likely benefiting gold, letting benefit gold here, and then resulting in a push higher and another attack at 1,440 USD per ounce. And so in fact, that's it on the markets. I haven't seen in the chat box any questions regarding other markets. If you're interested in any markets, please feel free to ask your questions. Then next week again, so we'll keep on using Zoom. I want to, by the way, also use the chance here to promote already the next webinar series here, which will take place from the 5th of August onwards. Then every Monday, Wednesday, and Friday in the morning from 9 a.m. Central European Summertime. In this case, my spot here is the 9th of August, or each Friday, but then at 9 a.m. And you can register also for this webinar series here in the chat box. Let me just see. I just have to see here. Where can I put the answer into? Okay, 1 second. This is not good because usually there was, Oh, this is interesting. So somewhere here, there's the button, but I can't find it. Okay, let me just show you where to find it then. Go to admiralmarkets.com and then you click here on analytics. No, I'm sorry, education, and then Forex CFD webinars. Just click on it, and there this will appear, or already appears. Okay, will appear rather sooner than later, the trading spotlight series. So for whatever reason, I'm not finding the chance here to share the link in the chat box. Also, if you're interested in this, feel free to reach out via email then to the Admiral Markets support. They will also share the link with you. And till next week, I promise I will have found here the chat box function and how to share a link. That's definitely something which is important, I think. And yeah, so that's it from my end. I hope you enjoyed the webinar. You enjoyed the platform. Please also feel free to send your feedback in regards to the new platform Zoom to Admiral. And yeah, so that's it from my end. I wish you happy trading. Watch your stops. Enjoy your weekend. Enjoy yourself. And take care. Talk to you next week. I look forward to it. See you and bye-bye.